So now we're going to move to the first session for this day, entitled Investment of Pension Funds and Development of the Financial Markets. I would like to ask Daniella Gutiérrez to come to the stage, the head of the AFP and Pension Fund Department of the Superintendency of Pensions of Chile, who will moderate this panel. And also the panel member Edgar Robles, consultant from the Inter-American Development Bank and director of the graduate program in economics of the University of Costa Rica. At the end of this session, we're going to have a Q&A session. But please, in that case, raise your hand and wait for the microphone to approach you. Please introduce yourself very briefly before asking any questions, if we have the time. So now the floor is for Daniella and Edgar. Good morning, everyone. It's a pleasure for me to moderate this first panel session. And we are here with Edgar Robles. Edgar Robles is an economist from the University of Costa Rica with a master's and a PhD in economics from the University of California, Los Angeles. Currently, he's a professor at the University of Costa Rica and director of the graduate program in economics. Professor Robles has 25 years of experience as an international consultant in institutions such as the World Bank, the IMF, the FAO, and the IDB, among others. Also, he has collaborated in improving the Social Security coverage and pension fund investment regulations in Colombia, Costa Rica, Ecuador, Salvador, and other countries, such as Great Britain, Guatemala, and some others, of course. He has developed all these projects as a consultant of the IDB and an associate consultant of Novaster. He has authored dozens of books and articles on topics related to economic growth, competitiveness, international trade agreements, corporate governance, pensions, and labor markets. Also, between 2002 and 2015, he worked at the Superintendency of Pensions of Costa Rica, where he was the superintendent. And along with the World Bank, he developed a risk-based supervision model based on the principles of the International Organization of Pension Supervisors. Also, before that, he was Vice Minister of Finance in his country. So, Edgar, the floor is yours. Thank you. I would like to thank AIOS for the invite, the IDB also for the invite and organizing this event, and to Osvaldo Macias, of course, and Paulina, who's been in charge of organizing this event, and also for the opportunity to share this with so many friends. And we're not, sometimes I see you more than I see some members of my family, so that it's also good to mention that. After being a professor for so many years, I've understood that most of the work that you do is related to the entertainment industry. So the purpose of this presentation is first to entertain you, if possible, but also to send you a message. So I have two challenges that are probably going to be quite difficult. Now, the main topic for today is something that you may think it could be quite obvious. I mean, what's the relation between the pension systems and the financial sector, or the development of the financial sector? So as I said, that association, it's quite close. We may say that there is a natural connection between pension funds and the growth of the equity market, which in our region it's even more interesting because we are at an early stage of the aging process. Florencia was telling us that we are in a process of accelerated aging, that by 2050 approximately we're gonna have, 25% is going to be people over the age of 65. But in the case of most countries of the region, we still have a demographic bond, if you may. So even if we've exhausted that in other countries, such as in Chile and Uruguay and Costa Rica, we are in a process that if we manage our pension funds well, we're going to continue to be able to create savings. So as we create those savings, we're going to be able to develop the financial markets for the same purpose for which the pension fund system was created, to have better pensions. Now, in our region, particularly in the countries where we have saving systems, and I'm talking about this idea of accumulation of savings, is because I don't want to think about capitalization or individual capitalization systems, but also that the evidence I'm going to be showing today say that the important thing is to create savings. And there is not just a possibility of having savings in the case of individual capitalization systems, but there are countries such as the Netherlands, for instance, that have completely funded systems, collective contribution, and they still create savings, significant savings. So there is a close relation between savings and pensions. However, what is particularly complicated in our region is to create savings. If you've seen the experience in Asian countries, for instance, they managed to create more savings without getting a contribution from the pension funds. In our countries, the increase in savings, or in most countries, is because of the pension funds. So it's been a forced saving effort. So this means that the pension funds become the most important institutional investors in the different countries. So in each of our countries, the group of pension funds, as mentioned by the superintendent from Mexico, turns into the investor that it's going to play the most important role, or turn into a financial player. So that, of course, is going to have an effect on the local economy. And this is what I'm going to try and talk about today. Now, if you see the financial history of the Latin American countries, and I'm thinking about back in the 70s, we can see countries that had high levels of debt. They were irresponsible from a fiscal perspective. They would spend more money that they would gain, and they normally issue government bonds to cover the difference. Now, the characteristic is that those government bonds were short-term, mostly. So if you have a financial sector, you have a mismatch of interest. So what one person wants, or what a saver wants and what the investor wants, are different things. You want to have the money available in the shortest period possible with high yield in the short term. However, the investor wants to, or a borrower wants to get the money for the longest period possible. Of course, naturally, there is a mismatch there. And there was no possibility of finding savers who would want to commit their money for 20 years or more, which is a problem today for many countries, to find people willing to save for more than 20 years. And the pension funds actually play that role. So they allow to get a better match between the interests of the investors and those of the savers. So these allow us to create a series of projects that in other circumstances would have been possible. And countries could only rely on international organizations to get the resources for long-term projects. Now, this is what the pension funds do today, because the pension funds create a demand for long-term assets to invest funds that they otherwise wouldn't have. Now, these graphs show the financial depth, which is an indicator that shows the number of credit between the GDP and the evolution over time, as the individual capitalization systems are created in Latin America. Now, the red dot shows the moment when the pension reform has been passed. That means that money starts being accumulated slowly, but then because of capitalization, you create more resources. So you can see easily whether there is a trend change after the approval of the reform, which means that the savings created in the pension systems create the development of the financial system through the creation of a more diversification of assets that didn't exist in the past. So that's the case of Chile, Colombia, Costa Rica, and the Dominican Republic. I also have graphs for the other countries, Mexico, for instance, and you can see there quite a peak there that goes down afterwards, which is the tequila crisis that they experienced. Because, of course, these factors are exposed to different situations. But in the Mexican case, they were part of a crisis that led to the devaluation of the Mexican peso and had consequences in most of the financial world. With the exception of Uruguay, all the countries have shown an upward trend in the financial systems once the reform has been introduced, the ones that force people to save for the pension. However, if we see what has happened in other countries, and I'm showing two countries only there, Argentina, that is one of the biggest in the region. Now, the financial system has gotten smaller over time for different circumstances, but they had the possibility of creating those savings. So there was a reversion over there in terms of they moved from individual savings to a pay-as-you-go system. So now Argentina has 40% of the national budget going to the payment of pensions. Now, in the case of Trinidad and Tobago is one of the countries, the largest countries of the Caribbean, and it operates as a financial center for the Caribbean.
Muy bien. No solamente los fondos crecen, el sector financiero se profundiza.
So there are new assets, there are new participants, there is the possibility for companies to be listed in the stock exchange. For instance, we can see this in Chile, but also the financial regulation has improved in the countries that adopt saving-based pension systems, because savings turn into a critical aspect for society. So you need to have the certainty that people are going to receive the benefits for which they are being paying for those contributions. And local regulations are more permeable to the international principles adopted as Basilia, for instance. So they started adopting best principles, such as the OCDE, for instance, or IOPS, or others. But also governance improves within the issuers of assets. So as regulation improves, companies issuing or the companies who are listed improve their governance systems in order to qualify to sold those assets to the pension funds administrator. So this movement that we've seen lately with the ESG investments, or this environmental emergencies aspect. And today, the regulation of the pension systems in the region are including these elements as part of that improvement in the governance, which is required for pension funds to be able to invest in those instruments. So there is also an improvement that we can see in regulations. And also, as countries allow international investments, the flows improve from and to overseas. Now, you may say that if you have the possibility for investment funds to invest overseas, that may be seen as assets leaving the country, but actually evidence shows that this is a coin with two faces. It's not just you're sending resources abroad, but you're also receiving more resources if you become more sophisticated when it comes to the pension fund system. And this needs to be like that, because part of the problems created by that higher level of savings is that you have a higher financial pressure. I mean, there is a higher number of demand per assets, and normally if you don't get a portion of those assets overseas, then the interest rates get depressed. I mean, we are sort of like victims of our own success. We have more savings, we create more demand because of the assets, so the price of those assets goes up. That means that the yield goes down. So we need to see in other countries the possibility of having higher diversification, but also we need to see that as a way to release the pressure that we would have internally if we were to invest the countries only internally. Now, in the region, there is only one country that maintains a regulation and that doesn't allow that, which is the Dominican Republic, but they are discussing actually about the possibility of changing that. Mexico used to be like that until 10 years ago, more or less, but now they've changed also, and the financial system has grown more. Now, the issue of stock capitalization. For instance, the case of Chile, maybe that's the country with the highest level of development in the region in terms of the stock market. And this has changed. It has changed the value of the companies, the listed companies, as a percentage of the GDP. There is an upward trend. Of course, the COVID crisis implied some changes, but if we consider the number of listed countries, that number of companies has continued to increase over time, and this is very much related to the type of regulation that they have here in Chile in comparison to the other countries. So as we force diversification, so that the principle of diversification is to invest not just in bonds but also in shares, we favor the development of the stock market. Now, if from the regulatory perspective we don't force diversification, it could be very difficult to create incentives for the financial market to develop in terms of the number of listed companies. Now, in this slide, I'm trying to say that evidence shows that the development of the financial market is given by the development of the pension system. So, if you don't allow for regulation to be more modern, so as to allow the existence of generational funds or multi-funds, depending on the structure you want to have, to focus on the life cycle, to have more diversification of assets for us to invest funds, to offer people the possibility of getting better yield if they so want to. So it's difficult if we don't have those things for the market to develop. The countries who haven't been able to get the development at this level, those who haven't been able to develop the financial systems, is because the regulation is not modern enough. Now, how does the pension system affect the financial sector or the economy in general? I need to zoom in. I need to get closer to the screen because I don't see very well. Okay, so we have the saving systems. We have the saving systems which is going to create the resources that are going to allow us to develop the equity market and to have an impact on the yield of the products. So this is a direct association. Now, if we have more resources, we're going to be able to have more investment. And I'm going to be talking about that also. But there is a direct relationship between savings and investment, even though from the theoretical perspective, that relationship, it's not necessarily so direct. Now, this increases the potential growth, which in turn goes back to the pension fund so as to increase the contribution payments to improve employment, reduce inequality, poverty, improve the employment market, and improving sustainability, fiscal sustainability. No, you always tend to think about the situation some countries would be if we didn't have a pension system that had created those savings. But actually, in the Chilean case, the problem of the pension funds for a while now is that the Chilean government is not issuing any debt. So they need to find a way to where to put the savings. So what we have is a virtuous circle. And in order to better understand this, we need to understand what creates economic growth. And in order to understand that, maybe we can think about our own families. I mean, what happens in our families? If we want to increase the income or the production of my family, I need to work more hours. In order to have more income, I would have to invest in more capital, such as more computers or better internet, for instance, or more books, etc. That would be a capital increase. But also, we would need to find a way to do more with the same resources that I have, to improve my processes, for instance, I don't know, to sleep more or to try for our children to study more, for instance. That's the productivity system that we know. So the same happens with countries. Countries grow because they generate more and better employment, because they invest more in their capital, and also because the product growth according to technology improvements and other things that are considered to be improvements in relation to productivity. I mean, to do more with the same. Now, if we see the pension system, there is a study from 2003 that is quite famous, prepared by Victorio Corvo, that tries to relate this concept of economic growth using these three measurements and to see how the saving created by the pension funds of the individually funded pension funds also had an impact on that. Now, for many years now, the economists have wondered about what caused economic growth, and they weren't clear on that, because most of that is explained by productivity, but productivity is not a standard concept. You don't see it at a macro level. So we started to think about measurements to measure productivity, but this is seen as all the improvements that lead to more efficient production systems so as to produce more with the same. So that's the most crucial element of countries that grow the more. They do it because they're more productive. So if I have more savings, I create more investment. So I create growth. So from the perspective of theory, if the financial markets are integrated, savings should find 4 areas that create more return. So if I create savings in Santiago, why should I invest in Santiago if there are other opportunities in other cities in the country or in other countries actually that may give me higher yield? By empirical evidence shows that there is a link between savings and investment. So that's called the Fester-Orioka paradox from 45 years ago. But today we continue to explore the issue of why savings need to stay in the same place. So if we have more savings in Chile or more in Costa Rica or in Colombia, we're going to have more investment in those countries, where the savings were generated. Now, the second observation from this paper by Corvo-Schmidt-Hebel is that there are improvements in terms of employment. I mean, the contribution of labor. I mean, it is assumed that if people perceive that the individual savings system are not imposed, but actually a contribution for my own pension, people would work more in the formal market, and also they would try to work longer to get their pension later, and the development of the development of the financial market and everything related to improving the financial regulation, corporate governance, more specialization, everything that we've been talking about, the innovation in the financial market. This is what has caused the development of the financial sector. So let's see the figures from these studies. And this study was prepared for Chile. 2001, then it was repeated in Chile and Colombia, 2010 in Colombia, 98 in Mexico, and from 93 and 2003 in Peru. Then I did the same study for Costa Rica a few years ago, and then we also did it for the Dominican Republic about 2 or 3 years ago. So what I'm showing here is that first, when it comes to employment, there hasn't been that perception, that this is just a contribution that is going to be good for my savings. I mean, maybe we could say that these savings are perceived as created voluntarily. I don't think so, but the effect on growth has been positive, but it's not, people don't see it. People continue to think in their contribution payments as something that is imposed, as something mandatory, otherwise they wouldn't do it. So if I have my right to a pension fund, I just run away. So I've worked in the world of pension funds, and as soon as you get the benefit, I mean, even as soon as you get to the age necessary to access to a pension fund, you do it. Now, in the case of the link between investment and saving, it's also a positive link, with the exception of Costa Rica. But in the other countries, it's the second element with the highest level of importance that tell me how economy grow, because of the effect of savings. And the main element that explains the contribution of the pension funds to the growth, it's everything related to the financial market. So the link, it's very direct. More savings, more innovation in the financial markets, and therefore more economic growth. Now, in general, these studies show that the contribution of savings to the growth of all of these countries in these periods of time is explained by 6% in the case of Costa Rica and Peru, all the way up to 22%, because of the savings generated in the pension funds, mainly because of an improvement in the financial markets. So what are the factors that can affect the savings, the pension fund savings? If we say that more savings created by pension funds lead to improvements in the financial sector, and that also leads to a better financial growth, what could go wrong to avoid this from happening? How can we break this natural link? How can we break that relationship? To reverse policies, for instance. So the first one is the weakening of the systems that created those savings, such as the anticipated withdrawals. And I'm saying this because in most countries during the COVID crisis and after that, there were some laws passed, unfortunately, in some countries, and in some countries they were proposed to withdraw savings early under a false premise that it seems to be intuitive, but it's not. Intuition is not always correct. But in the event of a drop in the economic activity, people want to have a lifesaver so that people can overcome the bad situation they're experiencing. There are problems of employment, problems to generate income, so we have savings and they just start distributing that early to people because they think that that is going to create employment and going to increase the economic activity. That's sort of like a shot of insulin for a diabetic person. So it's going to create a certain moment of well-being, but after a while, the situation is going to be the same. So the problems that we see in the pension sector comes from the employment sector, not the way in which resources are being collected. So if every time there is a crisis, an economic crisis, we start throwing those lifesavers, we're going to end up having no savings. And that it's been the experience of the countries that have allowed this to happen. But still, there are some countries to implement the 7th withdrawal. Here in Chile, they've been talking about a 4th or a 5th early withdrawal that wasn't approved at the end. But people who have access to these resources, unfortunately, are the most vulnerable people with very few capacities to save, and they are going to be more affected afterwards. People who have more resources, they don't really have major problems, because they can fund their expenses during the age period anyway. So if we think that savings create economy, I mean, less savings also leads to a lower level of economic growth. Now, here what we see, it's very difficult to think about what would have not happened. If I grow more because I save more, I perceive a better saving. But if I don't grow enough because I don't save enough, I cannot see that, actually. I cannot see what didn't happen. So it's very difficult to see that counter evidence. Number 2, weaknesses in the investment procedures. And this comes... Well, by the way, I have to say something. Next month, we're going to publish a book that we prepared with Alejandro Izquierdo and Mr. Tapia about what happened during the COVID with the pension fund. And we did different studies with different agencies from Latin America, prepare a study for Argentina, El Salvador, Peru, and Chile about this. And what we detected was that the COVID crisis was very, very short from an economic perspective. I mean, it was a crisis where production went down strongly, but the recovery was quite fast. So we wouldn't even have noticed it if we consider it in 10 or 20 years more, unless there were these withdrawals in these countries. I mean, actually, the impact of COVID in the pension funds happened because of the passing of these laws, because of the different circumstances that affected the different countries, of course. Now, we have another publication that is about at the bank also that wants to take the main errors made by the pension funds, which are normally related to collective funded pension systems. But there are 15 errors in the investment processes in Latin America. So it deals with the experience of different countries in the region. And what we detected are weaknesses in the investment processes. But I know that maybe this may sound that's not an issue really, but in some countries it is an issue. So for instance, there is no risk management. There are a lot of pension funds that only think about yield, but they don't really think about the risk related to their yield. So they're just looking for great yield, and sometimes they assume too many risks. And if they see a yield lower than expected, they don't like that. I mean, there are a lot of examples about that in all the different kinds of funds, individual and collective funds. Now, the lack of financial skills. So people in charge of investments are afraid of investing, so they start choosing portfolios that are not the best. Excessive concentration in public instruments, particularly in countries where the government continues to have a percentage of debt quite high, such as the Dominican Republic, Uruguay, or Costa Rica. Lack of investment in variable income instruments. So, because they don't know how to invest overseas. And also investments that are not thinking about the best for the contribution payers. For instance, that sometimes they want to work on the housing sector, but actually the objective of the funds is to pay for the pensions. So if we are paying better pensions, I can actually favor other industries, of course, that's great. but you need to continue to think about the main purpose. Then we see some deficiencies in the corporate governance of the pension funds. So, for instance, many of the laws in the region and the regulations ask for honorability conditions for the members of the boards, but they don't focus on the fitness aspect, on the suitability, so to make sure that the members of the pension funds collectively know about pension funds. And that tends to make very conservative decisions in terms of investments. Well, they're not really conservative. There are actually excessive concentration on instruments from the public sector or national instruments or fixed income instruments. Then there is a lack of procedures that leads to high discretionality in different areas within the administration of pension funds. So there are some areas that, because they don't have any procedures, they try to do things well, but they are a little bit recklessness. There are investment processes that are captured. I mean, there is no independence sometimes, and there are some reverse processes, and the regulator selects the instruments to invest. And that's not appropriate in terms of healthy governance. And there is no good operation in terms of the technical committees. I mean, we can talk about this later on. And this is a document that we have available at the IDB. There is no risk policies, and the deficiencies from the perspective of corporate government is one of the main deficiencies that we see here in the region. There are restrictions in the way in which assets are sold or bought. Now, sometimes the law prohibits, or the regulation forbids, the early purchase of instruments, and these are decisions. I mean, if I invest money, I cannot say that I need to maintain that until the deadline if all of a sudden the risk administration tells me that now is the right moment to sell it or to buy it, for instance. And in general, there are deficiencies in the investment policies, which shows how to make investments. Another important aspect is the poor definition of the three lines of defense. Now, what are these three lines of defense? It's a model developed by Basel, and today applies to any type of company. The first line of defense is administration. The administration that sometimes is represented by the investment unit. The second line of defense is the risk committee and the regulatory compliance, and they not only oversees the first line of defense, but also is some sort of whistleblower in order to report or alert about a concerning situation when it comes to the management of the fund. And number three is internal audit. So these three lines of defense need to act in separation, independently, and they need to report directly to the management line. So what we see sometimes is that the roles are mixed, they're not very clear, so we have investment and risk in just one area, in one unit. And of course, that breaks this definition of the lines of defense. And of course, we have the participation of management, or the manager or the administrator of the pension fund, and we see them involved in all these three areas. And finally, we have deficiencies in our regulation. Well, there are legal deficiencies, of course, but when regulatory deficiencies, when we have supervision based on compliance. I was part of the regulator for many years, and all we want to do is just to check boxes, and then you divide by 10, and that's it. You know, like when you're at university, you undergo an assessment process, and you just say, okay, what happens if an 8? 8 is a good grade. That would be, I don't know, a 6 or a 7 here in Chile. But doesn't necessarily means that, because even if you comply with different aspects, maybe you are failing in the most important one. And that, of course, affects the risk scheme for the administrator. So we need to change the mindset. We need to change the mindset in order to move from regulatory compliance towards a risk-based administration. Another element that is also very typical is the lack of valuation of the market prices. If you don't have any market prices, you cannot do assessment. We need that to analyze the risks of investment. If you only focus on government bonds, that's not the way to invest pension funds. You need to use market prices. Then we have excessive regulatory limits. So the region that started with the investment limit system, they need to evolve towards an investment system based on a prudent person model. So we need to get rid of that feeling that is very much related to regulatory compliance. And that's what the law says. Laws impose certain investment limits, but we need to change that process to make sure that investment processes are more dynamic, so as to have more economic growth and a higher possibility of better yield for the funds. And then, in most of the countries of the region, except for Chile and Mexico, and Colombia, I would say also, we have a lack of life cycles as part of the investment model. So we continue to have all investment in one portfolio as if all people had the same risk exposure, or if they should have the same risk exposure. I'm talking about the regular contribution payment. So we need to differentiate this based on the age. So as I was saying, the last thing that we have here are the legal restrictions. In many occasions, companies or the laws actually impose restrictions, legal restrictions, such as the existence of minimum limits for investment. The international principles say that we shouldn't have investment restrictions, but even though some countries say that there is a limit for the investment in the government and another one in housing and a minimum investment level in other activities promoting the social and economic development, but that turns to nothing. So legal restrictions are also part of the investment limits that restrict diversification, and sometimes those limits are related to prohibitions of the central bank because they fear that the pension funds have an impact on the exchange rate. In Costa Rica, for instance, when the pension funds run out of money, they say that they are creating a depreciation of the currency. But actually, it's a consequence of the policy of the central banks related to the interest rates. So after that, now they say that why the pension funds don't get the money out. But then it's because the interest rate locally is too high. So anyway, so there are limits that are established in the laws. And the last thing are political pressures that make the decisions being made by people who don't really know about the financial aspects, and they're thinking about other interests. So in summary, if we want to have pension systems that create more growth, economic growth, we need to provide the conditions that can allow those links that we have empirically shown that are real to happen, so that we have financial systems that are modern, that in turn also allow us to have pension systems that are more beneficial for our contribution payments and payers. And thank you very much for your attention, and I would like to again thank for the invitation.
Thank you, Edgar, for your very thorough presentation, which reminds us about the number of variables and how complex pension fund management is. Also, the diversity, although there's lots of similarities among pension systems in our countries. I have a question just to start up this Q&A. In the significant trends we've seen in management of pension funds. This is just to touch one topic among everything you touched upon. Among the clearest trends that we have seen is the persistence of increasing exposure to less liquid assets, derivatives, I would say. This has happened in Chilean funds and also in other funds of the countries that are here with us today represented. Recently, a few weeks ago, the CalPERS Fund, one of the largest pension funds in the world, announced an expansion in its private assets investment, 40%, I believe, of their funds. And that is a trend that you can see in international fund managers or administrators context. But how, well, in many of our countries, we've seen risk-based supervision, of which you know so much. And also, we need to try to find this alignment of interests between pension fund administrators and contributors that are also considering the risk of what is the amount of the pension that we'll receive. So what will be the challenges of that supervision, of considering this risk-based supervision, trying to lighten up the compliance-based supervision in this context of larger investment on private instruments that are less transparent, that are more difficult to manage because of their complexity. The first change is legislation changes and amendments in different countries that also focus on private instruments that are not listed in stock markets. In Latin America, we hear that all of those instruments need to be listed in stock markets. That means there's less probability of having private equity of private assets. Once that hurdle is overcome, once again, there needs to be reinforcement of the corporate governance context in pension funds. The regulation related to corporate governance in pension funds needs to be very stringent, because that's the heart of the possibility of investing here. You mentioned CalPERS. That's very interesting how master funds, professors of funds in the US or Canada are investing in our region in private equity. In fact, in Costa Rica, one of the main highways was funded by a pension fund from Canadian teachers' funds, although we have our own teachers' funds in Costa Rica, but they came from Canada to invest there because regulation didn't allow for it in our country. And it was so because we haven't been able to develop that part of the corporate governance structure. Something you see every day on newspapers in Costa Rica, on the first page, starts by saying that the fund of the Judiciary Power Fund invested by issuing in the stock market, but a real estate fund that didn't work. So there's a significant discussion on whether the right controls were used. So what needs to be strengthened before investing there is those who make decisions. And that is the largest challenge in our region, how we cause the strengthening of corporate governance so that the regulator may have the ease to see that those funds are being invested on these types of instruments, not from a perspective of whether they comply or not with a certain limit, but whether it is adequate or not, or investing on those instruments according to the risk that was involved in those investments. Of course, it's always too important to consider diversification regardless of the type of instrument. Given the time, I would like to thank Edgar for his excellent presentation and his contribution. And I leave you with Paulina. We'd like to thank Edgar and Daniella.